Good morning, good afternoon, good evening. It's 7:55 p.m. Friday, October 20. Well, welcome to our latest episode. Uh again, this is Mark Yu.
Wawi Santos present
And-
tonight.
yes, sir. And this is the Mark Yu and Wawi show, episode 86. Bears roar.
Yes,
Would you
but
think
don't
so,
be
Wawi?
scared. It's roaring hard. Yes,
Yeah. Well,
it's
quite a
the time of the
surprise.
Bears.
Yeah, because I think Jerome Powell, right? Well, we highlighted in our messenger, came out with some kind of reassuring statements that no, he'll probably just keep the rates high, but
Mhm.
there's no kind of like sense of urgency for him to hike up the rates. But
Yes,
mhm.
so it's just a waiting game again. And, some people are saying that they may start easing by the end of next year. So hold on tight. Looks like it's going to get rougher.
Yeah, because if it's gonna be long higher for longer, it's not going to be good for companies who are, struggling at this point in time. And we have already seen a bunch of companies that have actually filed for bankruptcy. So for those newbies or not so much familiar in jargons, financial jargons in that case. So Jerome Powell is the Federal Reserve Chairman. He kind of like dictates like where the Federal Reserve is going up or down in terms of their rates. The higher it goes, the tighter the money supply gets. So it's harder to loan. That's why you're seeing 8% mortgage rates at this point of time. That's why you're seeing 8% in new car loans and even a lot higher for used cars. So it all kind of like trickles down from the top, and the top is the Federal Reserve. So now, we're not financial advisors. Just a reminder, we're actually healthcare professionals based here in Texas. But me and Wawi have share the same passion and interest in the world of investing and investing our hard-earned money. So on a weekly basis, we take a look at the sentiment. So that's where we're gonna take a look next. So this data is from the AAII Investor Sentiment. They've been doing this since 1987. Quite a good summary of how investors think of the market. If it's going to go up, down, sideways, or well, those are the only three. So as of a couple of days ago, October 18, the latest reading is 34%. So we kind of dipped from the 40% last week, as me and Wami already highlighted last recording, that we have kind of risen above the historical averages last week. So a lot of
Hmm.
people got more bullish, but this time around, a dip of 6% at least to the sentiments of investors. And interestingly, they didn't jump to being a bearish. Actually, bearish also dipped a little bit from 36.5 to 34.6. So instead, more people jump into being neutral, meaning that they don't have a clue of what's going to happen, as their sense of uh, market direction, if it's going to go up, down. They're looking at sideways at this point in time. So where would you be at this point? What do you think? Would you be bullish or?
Well, after this bearish trend, you should expect some bullish trend next week. Uh, I think they're just processing the news uh, from the Israel
Mhm.
Gaza Strip. Uh, well, I won't call it a war, but a situation right now.
Yes.
So there's been some U.S. involvement there, and whenever they send somebody a delegation there, and now the president
Mhm.
reportedly is going, there's some anticipation of risk by the market. But interestingly for me, I'm bullish for next week because I think the market may be overreacting on this.
Mhm.
Some of it may be caused by the Jay Powell statement that
Right.
things can be longer.
Yeah.
And after they digest that news, they're you know the market will reprice again, and then based on earnings report, we will see probably some bullish trend again. I think part of the reason too is the market was pulled down by some bad earnings report by one of S&P 500's large company. Tesla apparently lost $100 billion.
Oh yeah.
With their current situation, the pricing that they're doing,
Yeah.
lowering their
Their,
prices.
their profits dropped by 44% in the recent report. Quite
Yeah,
astonishing drop, yeah, because of their price
yeah.
cuts. Mhm.
And so there's a flight, and people are, pulling out. There's some equity outflows from that, but I should expect some more inflows next week.
Yeah, if we're going to take a look at Tesla's stock performance today, it's down 3% to $212 a share. For the past week, it crashed by 15%. For the past month, it's down 17%. And for the past 6 months, it's still up 28%, quite a good amount. And still quite a ways from January 3rd, from $108 to $211, almost
Mhm.
doubling still, regardless of the recent drop. So Tesla is still kind of in a good year so far in terms of their stock price performance. But yeah, that's quite a huge profit drop for the company that's been known to be an innovator. And at this point, it's just cutting its prices of what we have observed so far. So we're going back to the sentiments. So next we're gonna take a look at the fear and greed index. So investors are now still at fear, a little bit less, 5 points less than last week's, but yeah, we are still well, that's not 5 points. 3, 6, 4, 5, 6, 7, 7 points less compared to a week ago. So the market momentum side that we kind of like to take a closer look every so often. This is the S&P 500, the basic price of it, versus its 125-day or four-month average. So more than a quarter, a little over a quarter. So it's back on the downside. It's on the negative side of things, and it's actually not looking good. It's a little bit further from the average at this point in time. It's about 351 minus 224. It's about 127 points away. I bet this is the largest gap since the start of the year. I don't think we have this quite of a huge gap. 125. Well, this one, 229, 334. 334 minus 229, 105. Yeah, this is the largest gap for the year. For those who are interested, what I'm doing is a simple math. The 125 day. How far has the index fallen away from the 125? So right now we are at the biggest gap. So it means that this momentum gauge right here, it's actually gaining some momentum, more momentum. It's not just
Mhm.
like just a recent, like compared to when couple of banks filed for bankruptcy back in March. Actually, the index only crashed or not crashed, like fell about 40 points away from the 125. Right now, we are more than 3 times that size. So better watch out. A little bit of momentum going down. That's the thing about looking at these kind of like technicals. Stock price breadth, McClellan volume. So not a whole lot of people are trading, or if any, it means that people are afraid of moving things at this point. Put and call options, you could definitely tell is zooming up again. It's back above 1 point, meaning a lot of investors are buying put options right now, trying to protect their portfolio against volatility or market sell-off. And the volatility index, wow, look at that, Wawi. We're back
It's up
above
again.
20, yeah,
Oh,
21.71. And this
wow.
is the highest since, I'd say, March, since the bankruptcy of the banks, the little banks. So definitely a lot of volatility right now.
Hmm.
Uh, lots of distance away from the 50-day moving average. Regardless, we're gaining some momentum to the downside, obviously, at this point in time. Yeah, for the volatility again, for the past week, we don't have any data. Sorry about that. I think I've been relying too much on Google, but yeah. So for the S&P 500 for the past week, we are down 2.7%. Trying to get the data for 5 days, but obviously it's way up. It's been the highest since the bankruptcy back in
Let's
March.
see if I can pull it up. 5 days.
Yeah. And for the volatility for the Nasdaq, meanwhile, it's up 12% for the past 5 days. As a result, Nasdaq is down 3.49%. So not quite a good week, not quite a good run.
Yeah, I just sent you the 5-day VIX
Oh,
report.
cool, nice.
Well, most of the investors are looking at treasury yields also, the
Yeah.
10-year treasury. So it's kind of like they're getting scared of it. I think, did it touch 5% already? Today's 4.91. So
Yeah,
it may have touched 5%. That caused a lot of that reaction of, fear reaction.
right.
People are not buying any treasuries. They're selling their treasuries, their long-term treasuries.
Yeah, we're gonna see that for sure in a little bit as we have an interesting finding in terms of like the 10 versus 2 year spread, which has been heavily inverted for the past almost 2 years now. Yep,
Hmm.
volatility is up 1.45% for the past 5 days. And for the groups, for the past 5 days, only two sectors are in the green, barely.
Hmm.
Consumer defensive and energy, 0.44 and plus 0.14. So none of that kind of matters in one's portfolio. It's so little. But it's still a lot better compared to real estate, which has suffered 4% drop, and as well as consumer cyclical, 4% drop. So all of the sectors are down in the red for the past 5 days. A lot of them as well down for the past month, except for energy again and communication services. And for the past quarter, same sectors are in the positive, just two of them, energy and communication services. The rest are in the red. Real estate is bleeding hard for the past quarter. But since the start of the year, the best performing sector has always been communication services, plus 37.89%, followed closely by technology, which was the worst performing sector last year. And the worst performing sector at this point of time since January is utilities.
Well, gold is up 1993.
Wow. From
So
2000.
almost 2000, and people are also putting some of their money on the Grayscale Bitcoin Trust, and I just sent you an image of that for today. So Bitcoin is up. So
Oh, wow.
I
Okay.
guess it's a tendency for people to look at certain defensive positions,
Mm,
either gold or precious metal, and maybe for the younger investors, uh, maybe more um, risky speculative asset, Bitcoin and Ethereum.
right, right. Trying to diversify away from traditional stocks.
Yes.
And what could be seen right now in this Reuters article as we take a closer look on the money flows, where the money is going. This was just published today. We're lucky to have been able to pull it up. It says here global equity funds see fifth consecutive weekly outflow amid rising bond yields. So it's been more than a month that global stocks have seen outflows. So let's see. Mm, Persistent rise in US bond yields, like what Wawi said, with strong economic data heightening expectations of sustained high rates. So investors divested $7.7 billion in global stocks, extended an ongoing selling streak. The US and European stock funds saw withdrawals of 4.57 billion and 4.12 billion respectively. Asian funds, wow, interesting. Asian funds drew in 1.4 billion fund flows. So Exodus sectoral, let's see, utilities, tech, and healthcare saw a lot of outflows. For utilities, the worst performing sector for this year, in the past week alone, recorded nearly $1 billion in outflows. Tech, the second best performing sector, also saw a lot of outflows, 803 million. And healthcare, 762 million. So these are kind of like defensive actually, right, Wawi?
Yeah, defensive moves look like they're
Why? Yeah, why would they sell
flight
more
from
in
risk.
healthcare? Yeah,
Yeah,
interesting. All right.
flight from risk.
Mm, Global bonds receive modest, little inflow, 80 million, very weak. Um, Investors allocated nearly 2 billion in government funds or government bonds. High yield saw a persistent outflow, 2.7 billion out of high yield, six consecutive week of decline. And wow, investors are still pulling out from money market. Interesting. 97.51 billion dollars being pulled out from money market. I think I saw a note this morning. Here we go. In a Bloomberg article, just managed to take a screenshot of it, that money market funds shrink by most since the week of Lehman Brothers collapse. That was back in 2007. So a lot of money have left the money market for some reason. Total assets dipped to $5.6 trillion from 5.7 trillion 7 days earlier. So
So where is it going?
it
Right?
says here, I think they're probably trying to time the market and do something major.
Mm-hmm.
Yeah, nothing said
It
about.
sounds like, yeah,
Mhm.
it feels like that's what everyone is trying to do right now, is trying to get another entry point.
Yeah, because money market is the safest option out there. If you don't know where to park your money, you can park it in the money market and earn 5%, just basically doing nothing. So
Mm-hmm.
pulling out nearly 100 billion from it, maybe herd mentality. A lot of people just trying to get a gauge more, get more cash at this point, preparing for something. But yeah, so that's one of the highlights of this fund flow research. So
Well,
uh,
something good right now that I'm seeing on my screen is, mega merger and acquisition
mm,
is doubled quarter over quarter. Deals of above $10 billion.
wow,
Uh,
a lot
yeah,
of activity in the banking.
yeah, I'll share it with you. It's from Goldman Sachs. So there's still some rainbow
Yeah,
that we can see
still,
at at the end of the tunnel.
still some hope, some positive signs of things.
Yeah, these merger and acquisitions are somewhat a good sign for now.
Right. And this is another publication from Bloomberg, a chart. It says here the Treasury bills now is yielding more than the S&P 500. So if you're a
Oh my goodness.
conservative investor, yes, you probably need to park a bunch of your money, or at least if you want to be conservative and don't want to risk losing a lot of money in the stock market, you can just basically park it in the 6 month Treasury bill
Hmm.
and earn an interest while waiting. Because if it's in the S&P 500, it's up or down regardless, what the dividend yield is at this point. And if you check this chart, this is amazing chart by Bloomberg. It never has crossed since 2001. And now treasuries are back, has more people now has more incentive to just park their money in the treasuries.
It hasn't crossed in 20 years. Can you
Yeah,
imagine that?
yeah, 20,
Wow,
22 years. Yeah.
22 years.
So probably that's one of the reasons why people are pulling back a lot from stocks. Being
Hmm.
not being fearful, but being smart actually.
That's always a good thing when the market is still rational.
True. So this next chart will be interesting. It's the This one I just saw this morning. So this was published actually in the early October this month. This is from Investors Business Daily, tracking the U.S. economy with Economic Optimism Index. So
Mhm.
there are several charts down here that indicates quite a negative or pessimistic outlook. So according to Investors Business Daily, its optimism index is at negative 16% as of October, way down compared to a year ago at least.
Mhm.
And outlook is also down, way down, negative 25%. Personal financial outlook is also down, negative 11%. Oh, this is a survey for 1,400 adults conducted
Mhm.
during the 3-day period, 27, 28, 29. So it's a small sample. Federal policies as well, negative outlook,
A small sample, but it somewhat reflects what the market sentiment is at this
right?
point. I think it's pretty good. You found a little
Mm.
pearl of survey there, Mark.
Yeah,
Thank you.
thank you.
Thank you for sharing.
Well, yeah, I was thinking it would have more, but yeah, we'll but we'll go back to our this one, the conference board leading indicators. This is mostly followed by experts in Wall Street as well. They put weighing, they put weight to this as well. So this conference board, they publish leading coincident and lagging indices to signal peaks and troughs in the business cycle for major economies around the world. So for the leading economic index for the US has continued to fall last month. So this was just published yesterday. So this index provides an early indication of significant turning points in the business cycle and where the economy is heading in the near term. So as of last month, September, the US declined again by 0.7%, following a decline of 0.5% in August. So a little worse compared to previous month.
Well, basically, that's what the Federal Reserve wants, a slowing down of the economy. So they're having a very significant effect right now at this time of the year. So more for the side of those that are saying that the Fed is most likely not going to uh, raise their interest rates in November.
True. Yes. And according to this study, the quote that was provided by the conference board, senior manager Justina Sabinska Lamonica, quote unquote, the LEI, or the leading economic indicator, for the US fell again in September, marking a year and a half of consecutive monthly declines since April 2022. So we've been on the downside since April of last year, and still we haven't seen recession. So
It's a strong economy, Mark. It's a very strong hallmark that the economy is still running very well.
true. Oh, I think I found the better chart barrage that we're gonna have in a little bit. That Investors Business Daily was like a teaser, but this is like a lot better. But let's just get through the LEI and then we'll jump on the next. For listeners who are tuning in, you're in for a treat for sure. Uh, so LEI is somewhat less negative. Recession signal did not sound. It still signals risk of economic weakness ahead. So far, the US economy has shown considerable resilience despite pressures from rising interest rates and high inflation. Nonetheless, the conference board forecasts that this trend will not be sustained for much longer, and a shallow recession is likely in the first half of 2024. A shallow recession. Yeah, if you look at this chart by LEI, yep, there's quite a negative pattern there. We're almost as close as one where we were back in COVID in 2020. That's quite a little bit alarming in terms of outlooks. So, okay. This is what the index comprises of, looks like. Financial components, deeply in the red. The S&P 500 index is actually barely negative.
Mhm.
Interest rates is negative. Look at the blue, the change. Non-financial, average consumer expectations for business conditions, somewhat negative there. New orders, negative. Building permits, negative.
Mm.
So those are the things that had pulled down the index. All right, so by the numbers, this is the chart, the good piece in our article review today. The deep dive by the numbers. So how retailers are stacking up on their inventory. So inventory, the higher it is, actually, you don't want to be having a lot of inventory to sell coming into the December or Black Friday, because it just means that you will be forced, if you don't want to keep those stuff, you will be forced to have a bunch of discounts, so as to get rid of that storage space. I mean, to have storage space and get rid of the inventory to make new for new orders if possible. So this is an article from Retail Dive, a Retail Dive. It's a pretty good informative article that they have published yesterday. Going into the third quarter, many major players cleaned up their inventories after last year's surge in stock levels. Not everyone fared equally, however. So it is good moving forward that we're going to take a note. Who are the leading merchants that have decreased their inventories and improved their turnover ratio, which is an ideal part of a solid
Wow.
business. So up on the first one, these are coming from the key operating metrics in the second quarter. On the first table, it's Walmart, the largest. If not, I think it's Amazon is the largest now, but Walmart following closely second. Inventory has actually decreased by 5%, which is a good sign. That's what we want. Um, and we also would like to see an increase in the inventory turnover ratio. It means that they turn over pretty quick. A lot of buying has been happening. So
Mhm.
5% down in inventory, positive, and 12% up in ratio turnover. So which is good, indicating strong business. According to the CFO, team continued to do a good job managing inventory. We're maintaining discipline. Okay. Next, Target. All right. Target actually did a good job as well. Inventory is down 17%, much more than Walmart. But yeah, Walmart has a lot of inventories for sure.
Mhm.
So in comparison to Target, and their inventory turnover ratio, which is better as a metric. If you're going to compare these companies, it's better to take a look at the ratio. So ratio for Walmart is 12%. That's pretty impressive because Target, even smaller company, its ratio is 6%. All right. Who's next? Kohl's.
Goals.
Kohl's registered an impressive inventory decrease too, 14%. And the ratio is pretty good too, 6.7. So almost close to target. So Kohl's is being disciplined. Their CEO said, looking to the fall season, we feel good about our current inventory levels and our ability to continue to manage inventory. Pretty good, Kohl's. Pat on the back.
Yeah.
Macy's. Uh-huh.
Yes, I was like surprised to see Kohl's
Uh-huh.
there, and now looking at Macy's, because and Target, because they were pressured down the past few earnings report,
Yeah, yeah.
and to see that they're moving their inventory at this early in the holiday season,
Yeah.
before it ramps up, is very promising.
Yep.
That's another sign that the retail sector is strong.
Yeah, they're at least bouncing somehow. Yeah, Target had to close a lot of stores too because of stealing or shrinkage, retail theft that's been going. So Kohl's is actually down 13%. It actually bumped up a little bit recently, October 13th. Target is way down 28% as well. So not a lot of investors cheering for the retail part of the thing. Macy's now, we're gonna take a look at Macy's. Macy's also showed a good numbers. Down 10% in inventory. Turnover ratio is up 1.6. Still a positive, but not that strong compared to the first three. All right, let's go to Dollar General. So Dollar General actually gained more inventory, 8.6%. Which is not terrible, but still, you were looking for it to go down, not to go up.
Well,
Inven-
their target mark, I think, is
uh
part of the reason. So
Yeah,
their stores are located in the most underserved market with
true.
lower income households.
Right.
So it shows what's happening right now. People are hesitant to buy things,
Mhm.
and with Dollar General's target market, that kind of reflects where they are. But I think they were rewarded by investors, because their stock had been up just recently. From I think we talked about that last week.
Yeah, it bumped. Yeah, right now it's still up 3.8% for the past 5 days. Oh my, but for the past year to date, it's been colossal defeat for investors.
Mhm.
53% down from 250 bucks a share to $115. Not a good sight, not a pleasant sight at all. So
Well,
next, mm,
well, for those bargain hunters, if they consider Dollar General a good company, then this may
yeah,
be an entry point.
yeah, would suggest a little bit more digging into, but yeah, definitely 50%
Exactly,
off.
yeah. Some due diligence needed there.
Yeah, 50% off. That's pretty good discount. Dollar Tree. Dollar Tree's inventory quite a little bit down, negative 1.7, but the turnover is strong, 9.4%.
Whoa,
Higher than
amazing.
Target, higher than what's the other one? Kohl's,
Kohl's
and
and
even
Macy.
Walmart. Yeah, I think Walmart is just no, Walmart is strong, 12.1%. A lot of turnover in Walmart, which is pretty good. Later, if we got a little bit more time, we're gonna take a look at the operating margin. Who's the most profitable? Um, Under Armour. Under Armour is the worst, I think. It's terrible.
Mm,
Inventories climbed nearly 38%, almost 40%. And turnover ratio, not a whole lot of turnover is happening. A lot of stock piling ongoing in Under Armour. If you're going to
mm,
look into Black Friday, you might take a look at Under Armour for sure because they need to get rid of a lot of things at this point. Inventory down 30%, the ratio. So not a lot of buying happening there. Okay,
mm.
Nike, we're getting somewhere. Inventory is down 10%, which is good.
What?
Yeah,
Finally, huh? Finally, Nike is moving some products.
yeah. I think it's one of the reasons why it's a stock spike as well recently after when it
Hmm.
released their earnings a couple weeks ago. Their inventory turnover ratio up 7.8%, which is strong. Okay,
Yeah,
Lululemon. Oh,
yeah. Nike is one of those beaten down stocks for a couple of years, and Lululemon is the one being rewarded. How did Lululemon do? Oh,
yeah.
okay. Go ahead and check Nike.
Yeah, Nike for the past month, it's up 12%. Quite eye-opening
Yes,
from
that's what I'm
$90.
saying.
Hmm?
Yeah, that's what I'm saying. Finally, Nike is getting some attention back from investors.
Yeah, it's still down quite a bit for the year, down 13%, but not as terrible as Dollar General. Dollar General is just downright beaten. Yeah, Lululemon inventory not so good. It's up 13.6%. And look at this, the turnover ratio, it's actually negative. So this is not a good sign for Lululemon. A lot
So
of
far, their profit margin has been good, but I don't
yeah,
know. It may
yeah,
be a holiday thing for this company, Lululemon.
yeah. And I believe Lululemon sells their pants in a pricey range. So this is not a good sign. People probably are finding other brands. Let's see if we're lucky if we have more. We do have more.
Ah,
Abercrombie. Abercrombie, look at that. 30% down in inventories. A lot of buying.
what?
A lot of buying happening in Abercrombie. Inventory turnover ratio very strong, nearly 40%.
Surprise.
Yeah, nearly 40%. So a lot of customers are buying. Oh, you know what? Probably they're jumping ship from Lululemon. Forget the pricey jogging pants. Let's just go to Abercrombie. Which is
uh,
good.
go for the cheaper brand.
Yeah, cheaper brand. It's better, more options. American Eagle Outfitters. Okay, inventory is down 7%, not bad, but the ratio as well is down 2%. So that's not a good combo. Still showing some strength there. People are interested in its brand, so that's not totally bad at all. Wow, Gap. So look at that. Abercrombie 30, both 30 and almost 40. But look at Gap too. Gap is almost 30% down in inventory, which is a good sign, and
Hmm.
22% in its turnover ratio. So a lot of buying happening, a lot of shoppers going to Gap. That's
Interesting.
that's pretty
Interesting.
good. We are planning your rate to be down generally in line with the year to date. Okay, well that's the last company that we have on our
Well,
screen.
interesting, Mark. People still like the brand names
Uh-huh.
when it comes to some of this clothing wear sector. But looking at Hanes brand, who's trying to get back into the into the younger market, uh, they're not doing so good like Gap and A&F. So
Yeah.
so it's a very interesting trend. People still like their brand name companies,
Yeah.
but they're
Yep.
not buying the expensive brand right
Yep.
now.
Lululemon for sure is sudden upsurge in inventories. That's not a good sign. So Gap is actually up nearly 16% for the past month, despite everything crashing. Year to date, it's up 4.5%, believe it or not. That's Gap for you, for us. Abercrombie, look at that. It's up 23%. So I think this all boils down to the Wall Street noticing how good they've been in their inventory. Year to date, it's outperformed Tesla, Abercrombie, and Fitch, believe it or not,
Hmm.
158% since its
Amazing.
impressive, impressive. So yeah, we have less than a minute left. Our apologies if we run out of time at this point, but I guess that does it for the latest episode here at Mark Yu Wawi Show. Hope you guys enjoy it. Please like and subscribe. Again, this is Mark Yu signing out.
And Wawi Santos signing out.